Yes boys, welcome back to another video. In this video it's going to be quite a long one because we're going to be going over the silver bullet trading strategy, but not just the strategy itself. We're going to go over everything within the strategy, such as literally the most key elements, the risk management and more. So without further ado, let's quickly get straight through it. So what is the silver bullet? So the silver bullet is a precision-based intraday trading strategy. It's designed to capitalize on high probability setups during specific times of the day, known as the macro time windows. So 9:50 to 10:10, 10:50 to 11:10, stuff like that. We'll get onto that in a bit further into the slides. But anyways, it was developed by ICT, who's Inner Circle Trader, also known as Michael J. Huddleston. So anyways, the strategy focuses on timing. So all the entries will be taken inside the key macro time windows, which we'll get into later in the video. Liquidity grabs, so liquidity sweeps essentially, so stop hunts, stuff like that. Imbalances, so we use fair value gaps as entries and retracement points. And then obviously the silver bullet does offer high risk to reward setups and trades. So it's not just about the setup, it's obviously about aligning time, liquidity and structure and everything else like daily bias. That's optional, but also we'll get into that further into the video. So yeah, we'll go. So the macro time windows. So why does time matter with the silver bullet strategy? So the ICT silver bullet relies on precise execution during specific macro time windows when institutional algorithms are most active. So these windows present high probability setups because this is obviously when the algorithms are most active. Just had to repeat myself there. But yeah, it's just when it's just more high probability just during the macro time windows. Anyways, the morning sessions. So these are the most high probable macros. Obviously the first, and this is like obviously the most high probable macro, is a 9:45 to 10:15 a.m. So loads of people say it's 9:45 to 10:15. Some of us say it's 9:50 to 10:10. It's just a 5 minute difference, guys. It doesn't really matter. As long as you're getting your entry around 9:45 onwards, you're gonna be good. So it doesn't really matter. Obviously the second one is 10:45 to 11:15 a.m. Still a high probable macro, but it's not really as volatile as the 9:45 to 10:15 macro. Price does tend to move quite slower in the 10:45 to 11:15 a.m. macro, but still pretty fast. Obviously not as fast as the 9:45 one. And then another macro that I trade is the 1:45 p.m. to 2:15 p.m. macro, which is, I'd say it's still high probable, but obviously the volatility isn't as good as you would get in the morning sessions. So that is why you'd rarely see me trading it. So going on to the next slide now. Why these time windows? So align with algorithmic price delivery by smart money. We'll often see liquidity sweeps and market structure shifts within these time windows. Also, these time windows are ideal for reversals and continuations based on the stop hunts. They also allow for high risk reward ratios with obviously slightly less drawdown than other setups, what we'd be looking at, other than the silver bullet. So a tip is always ensure trades are placed within the time windows and avoid trading outside of them because they'll lack confluence and lack institutional order flow and backing. So next slide. So the ideal silver bullet setup, the core setup criteria. So first of all, what we want to see inside the start of the macro is a stop hunt where price runs a swing high or swing low. And then after that, this confirms a smart money's intention before reversal or continuation. So typically, before you see a big move, we're going to see some sort of liquidity sweep prior to that or beforehand. Obviously, number two, we want to see a sharp displacement, obviously indicating the institutions are in this trade or they're going short or long, whatever. So obviously, we want to see a strong price move in one direction, and essentially, it has to create an imbalance. If it doesn't have an imbalance or a fair value gap, then we do not have a trade because the displacement or the fair value gap confirms the displacement. So obviously, third of all, fair value gap. So we want to see a clean imbalance, not just a tiny little imbalance. Obviously, you'll see when we're getting at the charts, I'll show you a bad example of a silver bullet setup, but essentially you just want to see a nice clean fair value gap that's been left open after the displacement move. And then obviously it acts as a re-entry zone where price is likely to react. So that is ideally where you want to get your entry. Obviously, smart money will be entering inside of the liquidity sweep, but obviously for you guys and obviously myself, it's going to be tough to do that. So that's why we'll wait for the displacement and the fair value gap before we enter. So fourth, we've got the entry and execution. So we want to enter inside of the FVG within the macro time window. Obviously, again, make sure it's inside of the macro. Stop loss is to be placed obviously at the swing low or swing high, or above or below a bullish or bearish PD area, which aligns with your trade setup. So I'll just quickly take you through an example here. So say we're in a buy from a silver bullet buy model. So you could put your stop loss at the swing low below the FVG. You could put it below the FVG. You could put it below a bullish order block. You could put it below a bearish breaker block. Just stuff like that. That's what I mean by that. Targeting opposing liquidity. So obviously opposing liquidity as in highs and lows. So if you're in buys, you want to target the internal range highs, which is going to be your low hanging fruit targets, and then you've got external highs liquidity or external range liquidity, which would be more tricky if you're just starting out trading ICT. I'd recommend you just trade the low hanging fruit objectives, so internal range fair value gaps, which would be your internal range liquidity, or a swing low or a swing high inside of a premium of the range. So say you buy inside of a discount, you want to exit in a premium of the range. So just a simple swing high in a premium, that's where you take profit. And then going on to number 5, these are optional but are more powerful. I mean, me personally, every single trade that I take, I always want to see a market structure shift. I don't know why I haven't included it in one of these ones. I don't know why it says it's optional. It's a must-have, guys. You just need a fucking you need to have a market structure shift. Order block rejection, that's just optional, so it just confirms just an extra entry point. Higher time frame bias. I mean, myself, sometimes I do like considering bias, but most times it's not really as powerful as people may think. Like, oh, higher time frame bias, you've got to trade with a bias, blah blah blah. As long as the setup's there, guys, and as long as you've got a drawn liquidity in mind, and it's just a nice clean A+ setup, you don't really need to worry about the higher time frame bias. Sorry, because I'm getting spammed. So anyways, next slide. So this is the silver bullet checklist. So before you enter a trade, you must have all of these checked within the checklist. First of all, is the trade inside of a macro time window? So is it in the 9:45 macro? Is it in the 10:45 macro? Is it in the 1:45 macro? Has liquidity been taken? So before the setup forms, has there been some form of stop run? So liquidity sweep essentially. Number 3, is there a strong displacement move? So for me, I want to see a nice strong displacement below a swing low or swing high, depending on the move. Obviously, going into more detail, it confirms institutional order flow and creates an imbalance. So yeah, again, you want to see a clean fair value gap, which is confirming the displacement. And a fair value gap is a free candle imbalance where price is likely to retrace, because price is always retracing into fair value gaps or targeting liquidity. The ideal entry point is obviously the fair value gap, because that is where smart money is likely to re-enter the trades. And number 5, does the trade align with a bias? So you could use the higher time frames such as daily bias to obviously align the daily order flow with a lower time frame order flow. It's optional again. Myself, sometimes I do trade with the daily bias in mind, but most of the times I really don't. I'm really not that fussed about daily bias. So number 6, does the trade offer high risk to reward ratio? So minimum, I'll go for a 2R, and you could potentially even target a 3R. just to justify the risk. If you want to trade less than a 2 hour, you can, but in my opinion, it's not really valid to do that just for risk purposes. You would target key liquidity zones or opposing fair value gaps, like we just discussed. Internal range liquidity, external range liquidity would be more riskier to target. But if you are going for external range liquidity objectives, you want to be taking partials inside of the internal range liquidity take profits. So number 7, does it fit your risk management plan? I mean, if you're trading funded accounts, you do never ever want to be trading more than 1% unless you're in a nice profit and you're about to pass the account. And even still then, I'd still not risk more than 1%, especially if you're trading the futures prop firm. Never trade more than 1%. And then reduce size after a loss. Obviously, we'll get into that in the next slide, I believe it is. And then last of all, never over leverage. Obviously, if you take a trade, you lose a trade. The worst thing possible that you can do is go into the next trade with double the size and just try and make your money back. That's just not what to do. So final check, if all conditions are met, if all of these on the checklist are met, take the trade. If any of these factors are missing, obviously daily buys, you don't really need to have it in the trade as a checklist, but it's a nice strong confluence if you want to add it into your plan. And then if any of these are missing, just skip the trade. It's not a setup, it's not a trade. So anyways, here is a risk management plan for the silver bullet. A strong trading strategy is nothing without proper risk management. The silver bullet model works best when risk is controlled and trades are executed with discipline. Exactly that. So key risk management rules. Maximum per trade, you want to be risking no more than 1%. And 1% is going to be your full size. So after a loss, you are going to want to half it. You don't want to double it. So you just need to get that in your mind. Number 2, stop trading after a win. So whenever you see you take a trade in the 9:45 to 10:50 macro, if you take a win, if you take our first trade as a W, just close your charts, close down your computer, your phone or whatever, and just stop trading for the day. The worst thing again you can do is see the win and then gain some sort of ego and just keep on trading and just get greedy. That's the worst thing you can do. Number 3, no more than 3 trades per day. So if the first trade loses, you need to wait until the next macro window again. So if you take a trade and it loses, the last thing that you want to do is try and take another trade within that macro, because essentially what you're doing there is you just chasing the money back. You're just trying to get your money back as quickly as possible. And especially again, see you are in a buy in the macro and then price reverses on you and hits your stop loss, the last thing that you want to be doing is going in for shorts, which is essentially just reversing the trade. So this is just a quick example. So first trade, if it wins, stop trading for the day. If it loses though, you'd move on to the next macro window. So say you've lost the first trade in the first AM macro, you go to the second trade. If that wins, you would stop trading for the day. So that would be your second trade for the day as a W. Then you would stop. But if that one loses again, then you would move to the last macro window, which is that 1:45 to 2:15 PM macro. Or you could trade the lunch macro. Obviously, we're not going to get into that in this video because it is slightly less probable. And I want you guys to take the most probable trades that you can. So we'll just stick to the 1:45 to 2:15 PM macro. So anyways, if that third trade loses, that would be your three trades done for the day. You would just stop trading, just shut the charts, bro. You don't want to be trading more than three times a day. I mean myself, even after 2 losses in a day, I just shut the charts. I rarely even go for 3 L's in a day. I mean, it's rare for me, but sometimes it can happen. It doesn't matter how good you are as a trader, you can take 3 losses in a day. So number 4, adjust position size after a loss. So after a losing trade, you want to reduce your size to minimum risk. Again, I want to repeat this, do not double your size. So say you start with your full risk, 1% per trade. If you lose, you would half your position size down to 0.5% on your next trade. and obviously wait until that next macro. And then if you lose again in that second day macro, you would half it again, down to 0.25%, for example. If 1% was your full size, you would use the 0.25% risk trade, and you would wait for the PM macro, 1:45 to 2:15 PM, and then only increase size back after recovering at least half of the previous larger trades lost. So what do I mean by that? So say you take a trade at a full 1% and you lose that trade at 1%, and say for example it was a $500 loss. As you half the risk to 0.5%, you want to win at least half of that $500 loss on the previous larger trade, which would be $250. So you want to make $250 before you go back up to that full size as 1% per trade. Anyways, risk to reward, it must be at least a 2 risk to reward. If you trade lower than that, it's going to be lower probability. So 2R is going to ensure that you're going to have long-term profitability, especially if you combine that with the silver bullet, which is quite a high win rate model. Number 6, avoid emotional trading. So after you take a loss, do not revenge trade. Please do not do that. You're going to blow your funded account, you're going to blow your live account, you're going to blow everything if you start doing that. Do not get into the habit of doing that. Stick to the process, not emotions. Losses are a part of the game. Focus on consistency. So here is a quick risk plan example. So trade number 1 is in the 9:45 to 10:15 AM macro. You've got your full position size, and say you take a win, you would stop trading. That's you done for the day. Okay, so again, first trade of the day, 9:45 to 10:15 macro, full position size. If it's a loss, you wait for the next macro window, and then obviously after that, the 10:45 to 11:15 macro, you would go in with half risk since you lost in the first day macro. But if you win there though, you would stop trading for the day, and then if you lose again though in the 10:45 to 11:15 AM macro, you wait for the last PM macro, which is this one down here. So 1:45 to 2:15 PM, 0.25%, which is half of the previous larger trade. If you win the trade, stop trading. If you lose the trade, stop trading, because that would be your free trades for the day. So it doesn't matter whether you win or lose. Overall, you would just stop trading after this last third trade. So key takeaways for risk management: stick to the macro time windows, do not overtrade. So essentially with the silver bullet, you definitely want to be entering your trades within their macro time windows. If you enter outside of the macro time windows, it's just going to be less probable. More times than not, price will hit your stop loss, unless, because this is the thing guys, it's always time before price. It doesn't matter whether you get a nice clean A+ setup, if it's not aligned with the correct time, then more times than not the trade's just not going to plan out. And then use position size and adjustments to protect capital, which is just that risk management plan, halving your position size after the previous loss. And the next one is stop after a win. One good trade is all you need, which is exactly right. The worst thing you can do again is take a trade, win, and then go into the next macro expecting another win with a nice little ego. You do not do that, because you're just going to get greedy and expect to pass the account within a day. Don't do it. So next one is minimum 2R per trade. You don't want to be taking any lower than 2 risk to reward setups, because over time, if you do end up losing more than what you are winning, your risk to reward ratio, tongue twister there, is just going to mess you up. So your losses are going to be controlled, and the winners will take care of themselves. I'll repeat that again. Losses are controlled, so you're controlling your risk. The winners though are just going to take care of themselves. Obviously if it hits TP, it hits TP, but if it hits stop loss, it's all on you. It's all about your risk. It's all about what you do on that next trade that counts. So common mistakes to avoid. Number 1, trading outside of the macro time windows. So taking trades outside the key time slots, I don't know why I put slots there, 9:45 to 10:15, 10:45 to 11:15, 1:45 p.m. to 2:15 p.m. All in Eastern Standard Time, guys. Remember, it's always going to be in New York time. Do not try and trade these times in your own local time zone unless you're living in New York or anywhere that's in the Eastern Standard Time. Um, so the fix for that would be only trading during the time windows when smart money algorithms are most active. So number two, no liquidity sweep. So entering before prices run a previous high or low would just be less probable. So to fix that, you would wait for a clear stop hunt or a liquidity grab. This confirms smart money is involved. Number three, weak or no displacement. Trading without a strong price move creates a fair value gap, so you do not want to be taking trades. I mean, even if there's a fair value gap there, if it's a tiny fair value gap and it's not really a displacement, you don't really want to be taking that. So the fix for that, you would look for a nice, clean, aggressive move that would leave a nice, larger fair value gap behind it. Doesn't need to be too large, just as long as it's nice and presentable. It just shows intent. Number four, forcing trades or over trading. I mean, taking the setup just to be in a trade, even if it doesn't tick all the boxes, that is not what you want to be doing. So the fix is if all conditions aren't met, as in the silver bullet checklist, if you go back to the previous slide, time, sweep, displacement, FVG, you would have to skip it. One solid trade is enough. Pardon me. Number five, trading against the bias. I mean, for me, it's not really the biggest thing for me, trading against the bias, because as long as I know what I'm doing, as long as I know what the drawn liquidity is, and as long as I know where the institutional order flow is directing to, I'm not really considering the higher time frame bias, but it is good for just starting out. So taking long trades in a bearish environment. So price on the daily time frame is moving bearishly to the downside, respecting all bearish PD arrays on the daily time frame. You don't really want to be looking for longs. You would ideally be focusing on shorts. I mean, especially on the 1 minute time frame, because the daily time frame's impact on a 1 minute time frame would just be quite mad. Like, if you just think though, like one little small movement on the daily time frame to the downside is quite a large movement on the 1 minute time frame. So just keep that in mind. So the fix would be use session or daily bias to guide trade direction. So you would align your silver bullet trade with the higher time frame narrative. But anyways, what do I mean by session bias? So we're talking about power 3 here, if we're talking about the session bias. So at the start of the session, you would want to see a consolidation or accumulation, and you would want to see a manipulation move to the upside. So say we're looking for shorts, would want to see a accumulation and a manipulation above a swing high, and then you'd want to see that displacement retracing to the fair value gap. That's where you want to enter, and that would be the beginning of the displacement leg to the downside, and that would be your distribution to the downside. So that is essentially your power 3 with the session bias. Number 6, ignoring risk management. So if you're using inconsistent size, so one trade you're taking a win at 1%, then you're doubling at 2%, you take a loss, you're trading at 0.5%, you're just throwing different percentages out there. You do not want to be doing that. Revenge trading after a loss or risking too much, just literally what I've just said there. Fix to that would be stick to your risk plan. Maximum risk would be 1% per trade. On a Top Step account or an Apex account, I'd probably just have 0.5% as your maximum risk. I mean, if you're listening to that, you're like, oh, well, that just means that it's going to take longer to pass the account. Well, good. I mean, would you rather it take longer to pass the account or faster to pass the account with increased risk to blowing the account? I mean, I know I would want a more consistent, more conservative approach to passing a funded, so that's what I'd be doing. So you want to be reducing your size after a loss, let the math work in your favour. Literally what it's just said there. So half in the risk, another trade, half in the risk, and then as you are in a win streak, you want to be increasing your size and then not going over that a 1% mark or 0.5% mark if you're trading futures brokers or futures prop firms, sorry, pardon me. So number 7, exiting too early, so cutting the winner short. So say you take a nice clean A plus setup and it's running in your favour. Do not want to be closing the trade at 1 risk to reward or less. Just because you see a little amount of profit and just because you see money like in the trade or the P&L going up and up and up, the last thing you want to be doing is worrying about losing them the P&L and trying to take profits early, because over time, if you keep doing that on a consistent basis, it's going to turn into a habit, and then that habit over time, it'll have quite a negative impact on your overall profitability as a trader. So the fix for that would be let the trades reach logical liquidity targets. So for me, if I take a buy, again for example, stop loss at, take profit at a 2R, you just have your take profit set at a 2R. All you would need to be doing then is just managing your stop loss. Don't be cutting the trade early, just literally all I do is just hold for that 2 risk to reward, and then obviously again just manage that stop loss placement though while I'm in the trade. So you just need at least a 2R to stay consistently profitable. So key takeaway, discipline matters more than perfection. Avoiding these mistakes will immediately level up your consistency and confidence. So any of these mistakes, avoiding them, just make you a profitable trader. Mindset tips for silver bullet trading. Number 1, one good trade is enough. Don't be chasing multiple setups in a day, especially if you take the first trade and it wins. So a single high quality silver bullet trade can make your day, quality over quantity. Be patient, not perfect. So great setups take time to form, A plus setups, blah blah blah. Forcing trades out of boredom or fear of missing out leads to losses. So the last thing you want to be doing, just because you've seen a displacement but there's no fair value gap and you think you've got a trade, don't take the trade. You just need to wait for all of the confluences. So time, liquidity, displacement, fair value gap. If you're trading liquidity, displacement, fair value gap but there's no time element there, don't take the trade. I mean, just because it looks like a clean setup, it's not going to be a clean setup in reality if there's no time element involved. But if you do get lucky and you win the trade, that's just going to be luck because you're not factoring in that time element. So number 3, detach from the outcome. Focus on executing your process, not whether the trade wins or loses. A good loss following your rules is better than a lucky win from a bad setup. Just like I was saying before, liquidity, displacement, FVG, but no time. Don't take the trade. And if you win, it's just going to be a lucky win, just like it says right here. Number 4, stick to your rules, especially after a loss. So losing trades are a part of the game. I mean, the best traders in the world, even the Goldman Sachs traders as a whole, and I think, can't remember what year it was, but they only had a 50% win rate. But it's obviously the risk to reward ratio that is making them profitable in the longer term. So just because you've had a losing trade, don't let it take you down as a trader. The worst mistakes come from revenge trading or abandoning your system after a drawdown. So say you take a trade, most traders, what they do is they just throw their trading plan out the window and they'll just overtrade, they'll just gamble, trying to get the money back. That's again the worst thing to do. Number 5, stay neutral, not biased. So you don't want to be getting emotionally attached to a direction. So you see price moving strongly in one direction and you want to enter on a retracement for a buy. That's the last thing you want to be doing. Just follow all the rules in the silver bullet and then you won't go far wrong. Let the market show its hand with a liquidity sweep, just like ICT says. It's essentially the market tipping its hand to you that there's a liquidity sweep and a displacement to the downside. That is when you want to react. When price creates a FVG, that is going to be your entry. Lastly, number 6, journaling trades builds confidence. So review your trades to reinforce good habits and identify errors. So it's just building on that edge. Every single trade that you want to be taking, you want to be taking a screenshot of the trade, and you also want to be journaling about the trade. So in the next slide, I think it is, we're going to be showing you a quick journaling template that I personally use. So you can literally copy the exact way that I journal. So your journal is your feedback loop, so you'd use it to grow. So for example, you take a trade and it's not inside a macro, you would obviously journal it in the template. Quick spoiler, it'll say is it in the macro or not. You would just write no. Then on the next setup, you would look at your last trade's journal and you'd be like, oh well, last time I took a trade and it was a loss, it wasn't inside the macro. This time I'm going to be trading inside of the macro. So you're just giving yourself feedback, more feedback, more feedback. The more feedback, the better. Just essentially that. A quick mindset mantra would be no setup, no trade. One clean trade a day is all I need. So the final thoughts and a quick trading plan template, which is quite a nice bonus for you. So final thoughts, trust the process, follow your rules, time, make sure, time, liquidity, displacement, fair value gap. Don't chase, let the setup come to you. Focus on execution, not the outcome. So your edge plays out over many trades, not just one particular trade. Losses are a part of the game, remember. That Goldman Sachs example, even ICT, he does lose trades. He's not winning every single trade that he takes. It's impossible. Anyone that comes to you and they say, oh, join my signals group, 99% win rate, I'd just block them. Review, refine and reset. Less is more, so you want to be avoiding over trading. Trade the best setups only, especially within one particular day. If you take your first trade, stop trading for the day. If you take a loss and you go past that free trades for the day threshold, that's just over trading. It's gambling. You're trying to get your money back. Just stop, bro. So next one, the silver bullet is a sniper model. Treat it that way. So every time you enter a trade using the silver bullet, ideally it's, well, most of the times than not, if you're using everything from the checklist, it's going to be a sniper model, meaning you're going to have more sniper entries than what you wouldn't have. Every single silver bullet trade that you take will most likely be a sniper entry. So you've got to treat it that way. It's not going to be a sniper entry though if you're trading on a high impact news day such as FOMC, CPI, blah blah blah, all them high impact news days. But we'll get into that shortly. Track everything. So you want to be keeping a trading journal. Review all your trades weekly to find patterns, strengths and weaknesses in your trades. So silver bullet trading plan template. So this is a quick bonus for you guys. Use this template daily to stay disciplined and well structured in your trading journey. So you can either just copy and paste every single one of these, but I'm going to be putting it in the description. So if you have a look, link in the description, I'll have a quick PDF format of every single thing that's in here. So first of all, start by the date. What was the date that you've took the trade? What was the time that you entered? So session bias. Excuse me. Were you bullish? Were you bearish? Were you neutral? Macro time window used. Was it the first AM macro? Was it the second AM macro? Was it the PM macro? Was liquidity swept? Did you take the trade without a sweep on liquidity? Did you take the trade with a displacement? A clear displacement? Was there a fair value gap in there that confirmed the displacement where you entered inside of, which you should have? Entry reason? Obviously it should be inside the fair value gap. There's no reason to be taking trades when there's no fair value gap. Another one, sometimes when price is moving too fast, sometimes it can not retrace into the fair value gap at all. So just stay a bit more alert for faster trading conditions, and you might be able to catch an entry not even side of the FVG. It might just retrace into a breaker block, for example, and then just keep dumping. Anyways, stop placement. So how many handles or points was your stop, or pips or whatever, depending on what asset class that you're trading. How big is your stop loss in terms of pips, points, handles? Target, same, pips, points, handles. How big was your target? Risk to reward ratio, was it a 1 to 2? Was it a 1 to 3? Was it a 1 to 1? That's obviously going against the trading plan. So even if it was a 1 to 1, you still want to be noting that in case every single trade that you take and you're closing it early, you'll notice that right here. If it says 1 to 1, 1 to 1, 1 to 1, you'll notice that you're not taking 1 to 2 plus setups. Result, was it a win or was it a loss? What did I do well? So you just quickly make a quick note. You just write down all the confluences that was in the trade. Did you execute on all the confluences correctly? Did you do it well? Yes, no. What could I also improve upon? That is also a good one to take note of and journal about every single day. So lastly, your edge is in repetition. Perfect the model by journaling, reviewing, and showing up every single day with a focus. Mastery comes from doing the same right thing over and over again. I'll repeat it. Mastery comes from doing the same right thing over and over again. But anyways, guys, that's it. That's me done for the presentation. Now I'm going to hop into some live trade examples. I'll show you exactly what trades not to take and exactly the cleanest setups and just valid models, silver bullet models that you can be taking. So let's hop straight into that now. Just an example for the first trade. Now this is a perfect scenario for a buy model for the silver bullet. So you've got your displacement, but there's no fair value gap. So you wouldn't take this entry right here. So you just keep waiting for that displacement of the fair value gap. Boom, there's your fair value gap displacement. Market structure shift. We've closed below a short-term high. So there is your market structure shift. Let's quickly mark that out now. And then you want to be setting a buy limit at the top of the fair value gap. Don't try and catch a nice sniper entry and go for the middle of the fair value gap or even the lower of the fair value gap. Just go for the top of the fair value gap and then put your stop loss at the swing low or the low of the fair value gap, which in this case I'm going to put it at the low of this fair value gap. And then we'll just target a quick 1 to 2 risk to reward ratio. So let's see how this trade plays out. And as you can see there, obviously inside of macro time window as well. Sorry, I forgot to note that. 9:45 to 10:15 AM, which is our first AM macro. Entry was just inside of the 9:45 macro. Literally, note how as soon as the macro opened, we've retraced into the fair value gap on that 9:45 minute. That would be your entry right there, right at the start of the macro. And then trade obviously goes ahead and smashes TP within just a few minutes. Literally 1, 2, 3, 4, 5, 6, like 7 minutes from the entry point. But yeah, that's the first example. And again, sniper entry. So every time you take a valid silver bullet trade, it's gonna be a sniper entry. Oh, and quickly, I just want to say it was after a higher time frame liquidity sweep. Sorry, I forgot to mention that just before. This black line here represents an hourly swing low, and as you can see, price tapped the swing low, and we did get some nice price action after it. And then that's where we took the trade. On ES though, so we're trading Nasdaq here. On ES did not take the swing low. So that represents a S&T divergence, which is just an extra confluence. You don't need it. That's why I haven't really included it in this video. So anyways, that was the first trade. So here, guys, is another example. Obviously, it's inside of the same trading day as the previous example, believe it or not. So anyways, here is the sweep. We've got that displacement leg taking out a short-term high for that valid market structure shift. Body closed above. We've got a nice clean fair value gap down here waiting to be getting mitigated. So we'll draw that out in time and we'll see if we can catch a nice sniper entry inside of the macro. So we're just going to put the position size tool there. We'll put the stop loss at the swing low. We'll just target a nice 1 to 2R, which is literally at that swing high, literally dot on with this external range liquidity on the 1 minute time frame at a 1 to 2. See how the trade plays out if we do manage to get an entry. But we've got the sweep, we've got the market structure shift, we've got a nice little displacement. Now all we'll need to wait for is that retracement into this fair value gap. So as you can see, price does retrace straight down on the fair value gap, and as soon as we retrace into the fair value gap, within literally 1, 2, 3, 4, 5 minutes, full TP is smashed yet again. So now I'm going to be showing you a bad example of a silver bullet trade, and this is just going to be a quick example of a trade that you should not be looking to take. But these two examples that I've showed you so far, these are the types of trades that you want to be taking, so just take note of that. So here guys is a bad example of a silver bullet trade. Also look at the bottom, we've got 5 AM in the morning, which is not inside of any macro time window. So there's the first confluence, obviously just gone straight out the window. And let's say you're just rushing the trade, you've seen the setup form, you're not really factoring in any time element whatsoever, and you just set your sell limit right here. Let's see how the trade plays out. So anyways, we've got the sweep, we've got the market structure shift taking out a short-term low, we've got the displacement. Now let's see if price respects this fair value gap and the stop loss. So as you can see, even in this example, we do get a little bit of profit, but nowhere near a 1 to 2 risk to reward. And then price does come straight back up and then smashes stop loss. And even if you did want to trail your stop loss, you could only trail it down to this swing high. And then price does reverse, takes you out at this swing high right here, or at this swing high over here if you didn't trail your stop loss. But anyways, this is a bad example of a bad silver bullet trade. Also note how we're taking out sell side liquidity, and then price does start respecting bullish PD raise to the upside. So just a quick one for you guys to take notes of. But anyways, that was the bad example of a silver bullet trade, not inside of the macro time window. There is a displacement, there is a market structure shift, there is a fair value gap, there is a minor sweep, but the trade does not play out. Why? Because it's always time before price. So you always want to be taking the trades inside of the macro time windows, never outside of the macro time windows. Anyways guys, that sums it up for today's guide on the silver bullet. Hopefully you guys found lots of insight and lots of value. So please like and subscribe. If you are interested in learning more from me, I've got a free group on Telegram, which the link will be inside of the description of this video. And as well, if you want to take it to that next level, I've also got a VIP paid group where members can watch me trade live every single day, trading MNQ, A-mini Nasdaq futures, the micros, sorry, every single day. They've got loads of PDFs, loads of trade recaps to learn from. They've got direct access to me, and they've just got way more stuff coming out in the future in the group. But anyways, if that's something that you would be interested, again, link is in the bio. Again as well, lastly, just want to note, we've got that PDF format. So if you're interested in the PDF format, just send us a message on Instagram. The link to my Instagram will be in the description as well. So if you want that PDF template for the journal template, sorry, just give us a message, link in the description on Instagram. But anyways, that sums it up for this video. So I hope you guys enjoyed. Please like and subscribe again. I'll see you guys in the next one.